A great question came in via email this morning on Tuesday, of course, September 20th. The subscriber question was, with FOMC hike coming on Wednesday, should we wait to open a trade or does it matter? Well, we've seen a lot of moves, whether the comments from Powell are coming out or whether it's the actual event of the hike being released. We've seen negative reactions. We've seen positive reactions. And we've seen both positive and negative followed by a reversal in the next few days. What is expected? Well, most feel that the 0.75% hike is likely. But with recent information that came out in August, some are projecting that a 1% hike is not out of limb. Very few feel that the 0.5% rate hike is still on the table. What is tricky? Again, the overall sentiment, talking heads and such, feel that that 0.75% rate hike is likely. But how would the market react to that? Would it be a positive if it was not raised by the full 1%? Or the reaction could be negative depending on the following comments. Or there might be barely any reaction that it's already priced in to the market itself. With the increased CPI numbers against expectations in August, the 1% has been thought to be on the table and a consideration. Many feel a 1% hike would cause a major downturn in the market. But then again, depending on comments after that event, would things settle down? Would it be immediate? Would it be a few days later? This poses the dangers of playing a known event in an uncertain market. Should we wait until after Wednesday, or does it matter? What is your opinion? That was the main question that came in via email from a Power Options subscriber. Positions we might consider before the event are the protected option strategies, married puts, and collar positions. Whether it is a longer-term married put based on the guidelines in the full course, the blueprints, or a shorter term, maybe under 20 or 30 days, standard collar position, where we sell a call at or just out of the money and buy an out of the money put to take in a premium. The call and the put have the same expiration. The pros of both approaches is that we have a controlled risk, a limited risk, 3, 4, or 5% that cannot be violated like a stop order can. If the reaction is negative and the market falls, we expect it to recover, we can adjust both the married put and the collar position. And if the reaction is positive, we can see profit in both positions. Now the cons, in order to do the married put or the collar, we have to purchase the stock, so it is capital intensive. We may quickly see the maximum loss in either strategy if the market falls beyond our expectations. Also, with the collar, we have a capped gain if the movement upwards exceeds expectations, but we'd still be in a position to realize a good profit of maybe 1.5 to 2.5% for that shorter term trade. Buying straddles or strangles. Buying a strangle consists of buying an out-of-the-money call, a little bit above the stock price, and an out-of-the-money put, a little bit below the stock price. A straddle is very similar, but you're buying both the call and the put right at the money with the same strike. The U-shaped profit and loss chart of the strangle, the V-shaped profit and loss chart of the straddle can help take advantage of wild swings in the market on a known event, earnings, rate hike decisions, others. But the market knows this event is coming, so implied volatility might be high on a stock, individual security, even ETFs such as SPY and QQQ. Now, the implied volatility on those options wouldn't be as high as, say, Tesla or something along those lines, but the cost of the inflated premium due to high implied volatility that is higher than normal for SPY or QQQ is going to mean extra cost in the position. The pros of these two positions is we can profit in either direction potentially with a wild movement. These can also be adjusted after a move, and they are low cost as no stock purchase is necessary. The cons, well, we may need a large movement as much as 5, 6, or 7% to realize a profit. If the market does not have a wide move and it stays within a range, we could start to see potential large percentage losses. That's with the lie of leverage. We may also expect an implied volatility crush, which might not give us as much profit as we wanted, even if we saw the movement that we desired. Because of the risk of 100% loss on the strangle and potentially on the straddle, but it will move away from the strike one direction or the other, this should only be done with a small portion of the account, maybe under 5% or so. Other positions we might consider, but do carry a high risk at known events, as we've seen before, are deep in the money covered calls or deep out of the money cash secured or naked put positions. These strategies will give us an income up front. We have a good downside protection and percent to break even. That means how far the stock can fall before we start losing money on the position. But if the stock exceeds our worst case scenario expectations, because we own the stock or put up the full margin for the cash secured put, we could realize large monetary losses to the downside of the position. The pros of these strategies: income is generated up front. So far, only the standard collar has given us that. It needs a big decline to hit the break even. Here we see an in-the-money covered call, buying SPY at around 385, selling the 370 call in the money for the 10th of October for around $19. If the stock stays anywhere above 370, we get assigned and make 1.2%. However, if the stock falls down about 5% or so, 5.5% to our break even of 365, okay, we're still okay. We can manage the position or roll the position. But if the unexpected happens and the market pulls down below that to 360, 355, we'd be in trouble by more than this position, but this position would be in trouble. The cons of the deep in the money covered call and the cash secured put, of course, are it's capital intensive. We need to buy the stock or put up the full margin requirement for the cash secured naked put. We have a capped upside gain in these scenarios. There's a larger monetary risk if the downward move is more than expected. Positions some investors we have talked to in these situations that they consider, but we see risk, are iron condors, condor positions, and butterflies, either all call or all put butterflies or the iron butterflies done at a credit. These are neutral strategies where you don't want the underlying to move too much. But with the irons, we can get more credit than a standard directional spread. The iron condor is a combination of an out-of-the-money bull put credit spread and an out-of-the-money bear call credit spread on the same stock. Some investors feel that going 10% out of the money is safe around these earnings events or known events, but who knows? The pros: the iron condor and the iron butterfly will give an extra net credit, a little bit of boost. For the condor, we can set the strikes wide apart if IV is high and still get a reasonable return. The butterfly can give us a potential higher return than the risk, but that high return is only realized if the stock does not move as much and is staying right at the sold option strike prices, which rarely ever happens. The negatives of these positions, with a known event coming up that may cause the market to move, is, well, it's against sentiment. These are both very neutral positions, and we're expecting some movement on the known event coming up. We can lose in both directions. If the market movement exceeds our upward expectation or downward expectation, we can see losses on either side. With these type of events coming up, is a non-move really the expectation? This is where we see the risk in this strategy, taking an unnecessary risk of trying to play a neutral position when we're expecting some movement after the announcement is made. Things we might not consider, or we might consider as a lottery ticket in this case. A known event coming up where in the past several months we've seen wild swings in the market one direction or the other. Maybe a few days later it reverses after that effect. Directional call or put buying. Buying a call, speculating that the market is going to be a bullish move after the event, or buying a put expecting a bearish move. Now, these could result in great profit positions, high leveraged returns based on the movements of the underlying security, if we are right. If we are wrong, and the market moves opposite of the sentiment that we chose, we could quickly see a 70, 80, or 90% loss of the cost we put into the position. This is the lie of leverage. If you're considering playing a rate hike move with a long call or long put, proper position sizing is key, just like the long straddle and the long strangle. The pros of these approaches is low cost. Don't need to buy the stock. We can use leverage in our favor. We can see huge percent profits, 100%, 150%, 200%, if the move is in the correct direction. The cons you have to watch out for, you're risking 100% of what is invested into the position. That's why proper position sizing is key if you choose to use this approach. We know that IV, implied volatility, is inflated going to this event, maybe not in high values, but after the event happens, we may experience an implied volatility crush, which would cause our options to be less than expected if we were using a theoretical pricing model to calculate what our option would be worth if there was a movement. We have to anticipate the change in IV in those cases. The power options, custom spread, or profit and loss chart can help you do that. And if there is just a meh movement, the market decides to shrug off whatever rate is there, that's not what you want to see either. There can be a lose on the position if there's no movement. You need the directional movement one way or the other. Speaking of which, one of my favorite positions to use, of course, bull put credit spreads, or maybe bull call debit spreads, bear put debit spreads. You heard us talk about that on the webinars in the past several months. But I would probably not consider these as a strategy to use with a known event coming up that could cause wild swings in the market, earnings, rate hikes, what have you. The directional vertical spreads, bull put credit, bear call credit, the bull call debit spread, and the bear put debit. As with just buying a call or put, these strategies can lose 100% of what is at risk. For a credit spread, it'd be the margin requirement between the strike prices. For the debit spread, it would be the cost that you paid to get into the position. It might be better to enter one of these, bull or bear, a few days after Wednesday's event when we get a better gauge of the market direction. Now, the pros of a credit spread or debit spread at any given time is we can set up a deep out-of-the-money credit spread or in-the-money debit spread, which would have a high probability of success, not taking into account the unknowns of a known event in an uncertain market. We can profit if the stock moves in the direction we selected, it does not move, or moves against our bullish or bearish direction only slightly. An implied volatility crush may work in our favor in these cases. The cons, just like buying a call or buying a put, we're risking 100% of the risk if we chose the wrong direction and the movement exceeded our expectation. And sudden, high percentage losses can happen quickly on these positions, meaning that if the market, I took a bear call credit spread, the market moved against me, goes above my sold call strike price, for example, well, I might be at a 20, 30, 50% loss on the spread trade. I'm going to have to adjust it. I may have to go several months out in time to roll it to try to manage this position. In summary, positions we would consider before Wednesday's known event: the conservative option strategies, married puts following the rules in the blueprint, or the standard collar position. Buying straddles or strangles to take advantage of movements in either direction, which may come at a high cost with implied volatility, but proper position sizing is key, shouldn't be more than 3 to 5% of your total portfolio. Positions we might consider, but we think carry a high risk if downward expectations exceed what we thought. Deep in the money covered calls with the high downside protection, or deep out of the money cash secured puts with that high percent to break even. Positions some investors consider to try to take advantage of the premium of higher implied volatility, but we see risk. Iron condors or iron butterflies, or the all call condors, all call butterflies, all put condors, and all put butterflies. Positions we might not consider due to directional risk. And due to the fact that we can lose 100% if the movement against our sentiment is beyond our expectations, straight buying calls or buying puts themselves, not in a straddle or strangle, or directional vertical spreads, bull puts, bull calls, bear call credits, bear put debit spreads. But every investor has their own risk tolerance. Let us know in the comments if you're planning to play the rate hike coming out on Wednesday and what strategy you're using. But this is also where Power Options comes in. We have patented search tools in all strategies mentioned and many more. You can screen specifically for the maximum risk you're willing to take, the minimum return you want to see, probability, delta, implied volatility, and so much more. We also offer signature tools, the long option finder to help you see which option might give you the best bang for the buck if you're to buy a call or a put based on your expectation of market movement, and also the spread chain to quickly help you evaluate spread positions that match your risk tolerance and criteria, or compare parity between the bull put credit and bull call debit, or bear call credit and bear put debit. Tools to analyze what-if scenarios if the market exceeds expectations in either direction, or to evaluate a change in implied volatility. And hey, if you've entered a trade and it went against you based on the movement that comes out after Wednesday's announcement, our portfolio tools not only help you track your positions, but you can evaluate rollout opportunities, adjustments, and more. Of course, there's a ton of strategy education and education on the tools on Power Options as well. Now, basic disclaimer, yes, the most conservative approach may be to wait until after the known event, after Wednesday, maybe even Thursday or Friday, or maybe the following week, to get a better market gauge and see how the market is digesting the information. Not entering a trade before the announcement, the known event, would remove any sudden surprises or unnecessary risks if you're wrong in your directional strategy. Proper position sizing is key for all of the option strategies mentioned. The maximum risk even on a married put or the collar, you don't want that maximum loss to maybe represent more than 1 or 2% of the total portfolio. And you don't want to trade these sort of lottery ticket straddle or strangle or buying a call or buying a put around a known event with more than 3 or 4% of the total portfolio. Always remember, options involve risk and may not be suitable for all investors. Again, if you're playing Wednesday's move, let us know in the comment section. If you have specific questions about strategy or about anything along those lines, always remember, send us an email or give us a call. We'll be happy to help.